Welcome to Plain Money. Today we're going to break down one of the most important concepts in all of finance, the time value of money, or TVM. Whether you're saving for retirement, taking out a loan, investing, or running a business, this idea is behind almost every money decision you'll ever make. Let's dive in. What is the time value of money? The time value of money is the idea that a dollar today is worth more than a dollar in the future. Why? Because if you have that dollar today, you can use it, whether you're investing it, earning interest, or growing it over time. On the flip side, if you wait to get that dollar, you're missing out on what it could have earned for you. Because of inflation, that future dollar will buy less. And there's always some risk. The promise of a future dollar isn't the same as having it in your pocket right now. Think about it this way. If someone offered you $100 today or $100 a year from now, you'd take it today, right? That's the time value of money in action. Why is TVM so important? TVM matters because it helps you compare money across time. Without it, you could easily misjudge the value of future cash flows. You might overpay for an investment or undersave for your future. In finance, TVM is what allows us to compare money today with money tomorrow in a fair, smart way. It's the reason behind interest rates, loan payments, retirement savings plans, investment decisions, and much more. There's a few key reasons why TVM is so important to investors. First, inflation. Over time, the cost of goods and services goes up. That means your money loses purchasing power. $100 today might not buy the same groceries 10 years from now. Next, opportunity cost. If you have money sitting idle, that's money that could have been invested or earning interest. Every day it sits still is a missed opportunity to grow. When faced with many investment opportunities, TVM can also identify which opportunity is best in present value. And finally, risk. The future is uncertain. A promise of money tomorrow might not happen. There's always some risk that the payment won't come through. How is TVM used in finance? Let's look at how this concept shows up in the real world. First, loans and mortgages. When you borrow money, like a mortgage for a house, the lender is giving you money today. They expect to be paid back with interest because they're giving up the use of their money now. TVM is what helps them figure out how much interest they need to charge to make it worth it. Then there's retirement planning. When you're saving for retirement, TVM helps you figure out how much to set aside today so you'll hit your future goal. Thanks to compounding, earning interest on your interest, even small amounts saved early can grow into a big balance over time. It also shows up in investing decisions. When companies look at a project, maybe building a new factory, they estimate how much cash it will bring in over the years. They use TVM to calculate what those future dollars are worth today. This is called net present value, and it helps them decide if the project makes financial sense. In bond pricing, TVM helps investors figure out what future bond payments are worth today so they know what price to pay. When it comes to business valuation, investors estimate the company's future profits and discount those back to the present to figure out what the company is worth today. And it comes up in everyday decisions too, like choosing between taking a lump sum now or a series of payments over time, or deciding whether to lease or buy something. TVM is what lets you compare these options fairly. There are two main formulas in the time value of money. First, future value. This tells you how much your money today will grow to over time. The formula is future value equals present value times 1 plus the interest rate raised to the number of periods. For example, if you invest $1,000 at 6% annual interest for 5 years, you multiply 1,000 by 1.06 to the power of 5. That gives you about $1,338. Second, present value. This tells you what a future sum is worth today. The formula is present value equals future value divided by 1 plus the interest rate raised to the number of periods. So if you want $2,000 in 4 years, and you use a discount rate of 5%, you divide 2,000 by 1.05 to the 4th power. That gives you about $1,645 today. The time value of money is everywhere in finance. It's what helps you make smart decisions about loans, retirement savings, investments, bonds, business deals, and so much more. If you understand TVM, you've got one of the most powerful tools in finance on your side. Thanks for watching. If you found this helpful, be sure to like, subscribe, and stay tuned for more clear and simple finance tips from Plain Money.